Hey, think back to your biggest night. Maybe you're on the floor at the Bellagio, or maybe you're just sitting on your couch on a Sunday afternoon staring at your sportsbook app and you hit a parlay. You know what the feel of that rush is like, right? $50,000, you're up. But we all know how the season goes. A bad bet here and a cold streak there, and come December 31st, you've given it all back. You check your win-loss statement, it's in a perfect zero. You won 50 grand, you lost 50 grand, your net profit is exactly $0. And usually that's where the story ends. You didn't make any money, but you didn't lose your shirt either. In the eyes of the IRS, historically, this was a no harm, no foul situation. Basically, you deduct your losses, you cancel out your wins, and you move on, right? Wrong. Because starting January 1st of 2026, the wash, as I like to refer to it, is officially dead. Thanks to a massive change in the tax code, the IRS now looks at that break-even income and sees taxable income. So even though your bank account is still at zero, the government tells you you owe them money. And today I'm going to show you the math that it's about to ruin your tax return. You see, for decades, the tax code for gamblers was simple. It was called the wash. If you won $50,000 on a jackpot, but you could prove that you lost $50,000 in the same year, your net tax liability was zero. I mean, let's face it, you've been to Vegas. You hit a streak and you're up maybe $30,000, $40,000. If you're like me, I'm staying at that table and I'm probably giving it all back, but I'm having one hell of a good time. Now, the rules have changed. The IRS viewed gambling back then as a net gain activity. And if there was no net gain, there was no tax. But the Big One Beautiful Bill Act, or OBBBA, just took a pair of scissors to that rule. Thus, starting January 1st of this year, Section 165D has been amended. You're now only allowed to deduct 90% of your losses. That's a 10% difference in what tax pros are calling the haircut, and it's a total game changer. I mean, let's look at the math. If you won $50,000 this year and you lost $50,000 under the old rules, you owe zero. Under the new rules, you can only deduct $45,000. That leaves you with $5,000 of taxable income that doesn't actually exist. You're paying for a profit you never made. It's like the government is charging you an entry fee for every losing ticket you ever bought. You might think, hey, I'm not a high roller, this won't hit me. But the law is actually a trap for two specific groups. First, you got the high volume pro. If you're a professional poker player or a sharp sportsbook bettor moving millions, this is an existential threat. And I hate to use that word because it gets overused. But if you win $2 million and you lose 1.9, your real profit is $100K. But the IRS says you can only deduct 90% of those losses. And so suddenly your taxable income jumps from $100,000 to $290,000. You could literally owe more in taxes than you actually took home. Now, the second group is the casual itemizer. And to deduct any losses, you have to itemize your deductions on Schedule A. And if you take the standard deduction, like 6% of Americans do, you can't deduct any losses. You end up paying tax on 100% of the wins. But even if you do itemize, you still have that 10% penalty lurking there in the background. And here's the kicker. The phantom income inflates your AGI, and this is what no one's talking about. You see, a higher AGI can phase you out of child tax credits, student loan interest deductions, and even increase your Medicare premiums. The IRS isn't just taking a cut of your bets, they're using those bets to disqualify you from other tax breaks. So you're probably wondering, why the hell did they do this? Why break a system that worked for over 70 years? Well, it comes down to the budget in Congress. They can't quit spending. You see, when the OBBBA was being debated in the Senate last summer, they needed a revenue offset and a way to pay for tax cuts in the bill. The Joint Committee on Taxation estimated that a 10% cap would bring in over $1.1 billion over the next decade. But there's a massive backlash brewing. Lawmakers from Nevada and, of course, New Jersey are already sounding the alarm. They know this is going to drive bettors away from legal, regulated sports books and back into the arms of offshore illegal sites that don't report to the IRS. If the government gets too greedy, the whole legalized gambling experiment could potentially crumble. So listen, here's what you need to do. Keep an eye on the Fair Bet Act. It's a bipartisan bill introduced to restore 100% of the deduction. There's a lot of pressure on the current administration to fix this before the 2026 midterm elections because taxing people for losing money isn't exactly a winning campaign slogan. So what do you do if you're betting right now in 2026? First off, double down on your diary. All right, the IRS requires contemporaneous log of every win and loss. So in a 90% world, you cannot afford to lose a single receipt. Every lost ticket you don't document is money straight out of your pocket come next April. Second, talk to a pro about session accounting. The IRS allows you to net your wins and losses within a single session, like one night at the slots or one specific poker tournament. If you net them correctly before reporting them on your return, you might be able to minimize the impact of that 90% cap. But be careful. The definition of a session is a legal minefield. And you don't want to DIY this yourself because the numbers can be huge. So essentially the bottom line is this. The IRS has officially turned breaking even into a taxable event. Whether you're a pro or just a weekend warrior, the house just got an edge at 10% steeper. And the house in this case is the federal government getting their VIG. If you think this law is insane as I do, hit the like button so YouTube pushes this out to more people. And let me know in the comments, are you going to change how you bet this year because of this? I'll be tracking the Fair Bet Act closely, so subscribe for updates the second this law gets repealed. Listen, I'm Clint Coons with Anderson Business Advisors, and thanks for watching.